Aditya Birla AMC is actually come out with a very wonderful piece of research. Harish Krishnan is joining us now to talk more about that. How the shifts are happening in asset allocation in India. Perhaps some changes are happening which haven't been seen for a very long time. Harish, afternoon. Thank you so much. It's a very interesting piece of research your team has put out. Talk to us about what shifts are we talking about here, and how durable do they appear?
Right. So this report is basically talking about the household savings pool and how that has evolved over time. Right. Now, obviously, it's a very personal topic, given the fact that the habits of savings and where it is allocated change over generations, and what is typically considered as wisdom passed on from say one generation to another kind of persist over a long period of time. So over a period of time, we have generally seen a financialization of savings. So when we talk about the word savings, there are two aspects that one needs to differentiate. One is, let's say that in a year we earn some income, and on that we have a savings pool coming through. So that is like the flow of savings. And then you've got what you already have allocated over periods of time, say like an FD instrument, etc., which also gives in a certain amount of interest income. And then that stock of savings, how that is allocated is what we have considered. So what we have seen is that over a period of time we have seen a dramatic increase in the overall savings stock of household wealth in India, which is obviously a welcome news. And a lot of that savings, if you look at it in India, has been traditionally driven by physical assets and to a certain extent into financial assets. So there are broadly two big buckets of physical assets, which is one is into real estate or property, as it's called, and the second is into gold. And both of these continue to be quite strong, with more than two-third allocation and beyond into physical assets. And then there is the financial assets, which includes various asset classes, including, you can say, equities, including fixed income in the form of deposits, which are there in various banks, etc. And then you've got also the longer term savings construct, be it in terms of PF and other products which are financial in nature. What we've seen, and the important thing is that clearly over the last 10 years or so, we've seen a material shift towards the financialization of savings that got accelerated post demonetization in 2016, where we saw a lot more coming into the financial savings. But even now, when we talk about it, and when we look at these numbers, we just realize that we are just a small fraction which is getting allocated into financial savings. So that's the bigger picture that we are talking about. That we are just at a small tilt towards financial products that we have made, and within financial products, obviously a significant amount is still into traditional products of say the fixed deposit, etc., which obviously have a role and place in any portfolio, primarily from the fact that it gives a greater certainty in terms of cash flows, etc. But what we've seen it is that its ability to beat inflation is almost at par with that of say various other asset classes, including equities, over a 3-5 year rolling basis. Therefore, given the fact that it can also underperform inflation on a rolling 3 year basis on a similar construct to that of equities, do we really not benefit by moving more and more into equities, where the ability to double the money over reasonable amount of time frames? What we've seen is that typically between say 7 to 8 years, there has been a doubling of wealth in equities. Even in some terrible phases. Compared that to say the fixed income or fixed deposit instruments, where post tax possibly that's doubling every 15, 16 years. So the question that we have is that even in terms of what we think is financial savings, can more and more start coming into products like equities. The second and possibly most startling observation that we have is that, while we keep talking about SIP numbers and how big they have become and how large they have become, etc., the total amount of cash which is there in various households is almost 75% of the total value that various households have put into equity instruments, including directly through purchase of equities or through products like mutual funds, where they come in through, say, primarily the SIP route. So 75% of what is their wealth in equity markets from a household point of view is in just cash earning nothing for the household. So that's the amount of massive shift that can happen over periods of time.
Harish, you have also done some comparisons of this shift in other developed economies in the past. What does history show? What phase of this shift could India be in right now? Some call it the 401k movement in India, etc. So, what phase is it? The early phase or the mid phase? And this flow which has just started or shift has started. Do you think it could be a decadal or even longer kind of a phenomena?
I think we are in the very early stages of this cycle. We are nowhere close to the mid cycle. So if you look at, say, equities as a percentage of either the total GDP or the total wealth, if you were to look at it, we have just gone back to close to about 2007 levels. So it isn't that, while obviously from 2007 levels, it went down over the course of the last 10 years or so, we have inched back up. So we are nowhere close to, anywhere close to a mid cycle also. So that's point number one. Secondly, when we look at, say, markets like, say, the US, where we've seen a rapid shift of financialization of assets, as you rightly called out, from the 401k kind of regulations that kicked in, where we saw close to about 45% of household wealth into equities. We are like a small, tiny fraction of that today. And so we think that, given the EPFO mandates that have come through and which will potentially further increase their allocation to equities, with a growing cult of what we are seeing in terms of investors' attention span coming into equities, with a growing SIP culture, and with the growing trends of moving into more evolved categories, including products like asset allocation products that various mutual funds offer, we do think that there can be a material shift. I think if I were to call out, what we have seen so far is just the flow part, which is basically, like I said, the savings that come from a yearly income, that is moving more and more into, say, financial products and including equities. We haven't yet touched the stock of assets, which is the balance sheet of assets. That is just not yet started. And we think that a lot more will come in as more and more generations of Indians realize that, a lot of their wealth historically has been put into commercial real estate, has been put into assets, including gold, which is a great asset. Nobody is, kind of disputing the validity of these assets. But do we need in that proportion that we have? Is where the question really comes through. And I think as more and more of the wealth of people, which is the balance sheet or the stock of savings, move into markets, I think we have just about started that journey. So it's a long way to go. We've seen this happen in the US, wherein over, say, two generations, over, say, 50, 60 years, we've seen that move from, say, a single digit number in terms of their equity allocation by households, move up to 45, 47%. We are currently in the mid single digits in terms of our allocation to equities, and we see a material shift happening over generations and over decades as more and more Indians adopt this financialization of their savings.
Very quickly, just one last word. Let me play the devil's advocate. This is an asset class which is performing right now. A lot of investors also tend to be chasing performance. If we get into some kind of a bear market in 1 or 2 years, do you think these flows could be fickle? Could they go back? Or do you think this time it appears more structural?
Sure. So clearly, near-term callouts of asset classes, are difficult and should not color their allocation trends. Just like we buy into real estate or we buy into gold, it's not necessarily to take a call saying that the next 6 months or the next 2 years their prices are going to be higher. Of course, we do want it in terms of either greater assurance of savings or in terms of capital appreciation over the long term, without necessarily minding the near term journey of these asset classes. I think a similar kind of a construct is starting to emerge into asset classes of the financial side, including that of fixed income, as well as, more importantly, into equities. So I think that shift is starting. The only solution to it is to think in terms of the time to double money. Right, the time to double money in various asset classes, including FD, like I said, could range from maybe say 14, 15, 16, 17 years on a post-tax basis. Whereas, while there can be shocks over the course of the next 2, 3, 4 years, the time to double money in say an equity construct varies from as low as say 8, 9 months. If you had bought it at the absolute bottom on March 23rd, 2020, then your money doubled in less than a year's time. So it could take maybe about 14, 15 years in the if you had bought it at the peak of 2008, then it took that much amount of time. The reality is, on an average, it's between say 6 to 9 years, which is where bulk of the household wealth can get created. The third and possibly my last point in this is, as someone who's wanting to allocate more and more into equities, and where we are just at the starting point, ideally we would want lower prices than higher prices. So effectively, we should, as a society, actually welcome lower prices in the near term, so that we can put more and more money into work at better prices, rather than wanting the benefit of a small mark to market on the small allocations that we have put into equity so far. So I would think that I think a growing trend of educating households, the growing campaigns that the industry have been doing, all of that, to my mind, suggests that over the medium term, we are going to see a lot more of monies coming into equity markets from the household savings.
All right, Harish, always enjoy our conversations. Thanks very much for your time. That was Harish Krishnan of Aditya Birla AMC.
If you like this video, then like, share and subscribe to ET Now.